2025 didn't just go badly for the US dollar, it got hit hard. The dollar logged its ugliest year in almost a decade, and the punchline is simple. Your paycheck buys less, your savings leak value, and 2026 is setting up to make that pain louder. Because while most people were watching stocks, the real story moved in the plumbing. The Federal Reserve stopped tightening, flipped the lever, and liquidity started creeping back in. Not a headline, a pressure change. And pressure changes move everything. I'm your host, and this is our channel, the place where we don't gamble, we measure. Now watch this. A weaker dollar isn't just a currency thing. It's a tax you don't vote on. It shows up at the grocery store, in rent, in insurance, in that random, why is this so expensive now? Moment that hits you in the chest. And here's the trap. The dollar can look calm on a screen while it's bleeding in real life. That's how it gets you. It doesn't explode. It erodes. So what actually happened? The dollar slid about 9% in 2025 versus a basket of other major currencies. That is not a rounding error. That is the world repricing the cost of holding dollars while the US shifts back toward easier money and bigger deficits. And if we're honest, this didn't start in 2025. The dollar has been losing purchasing power for over a century. If your grandparents talk about a movie ticket and a snack for a handful of coins, they're not being dramatic. They're describing a different unit of account. Here's the part we have to separate cleanly. Fact. The buying power trend is down over long time frames. Interpretation, policy choices speed that decline up or slow it down. And 2025 accelerated it. Let's talk about the three forces that bent the dollar lower, without turning this into a textbook. First, interest rates. Money is lazy, it flows to where it gets paid. When US rates fall, the rent you earn by parking money in dollar assets falls too. And when the rent falls, the demand cools. Think of the dollar like a VIP wristband. When the wristband gets you into a club with great perks, high yields, people fight to get it. When the perks fade, the line disappears. That's what rate cuts do. They make the wristband less special. Now, the second force is the one everyone pretends not to understand. Money creation. We don't run on gold, we run on trust. And trust is fragile when you add new dollars faster than the economy grows. When new dollars appear, each existing dollar owns a smaller slice of the pie. That's not politics, that's math. Here's the mistake most people make. They think inflation is a price problem. It's not. It's a currency problem that shows up as prices. Now the third force is the monster under the bed that becomes real the moment rates fall: debt. The U. Hess government runs a deficit. It collects trillions in taxes, then spends trillions more. That gap gets financed with borrowing. And that borrowing only stays painless if buyers keep showing up. So ask yourself this. If we're paying less interest and we're borrowing more, why would the world be more excited to lend to us? Exactly. It's a confidence game. And let's make it visual. Imagine a household earning $5,000 a month and spending $7,000. They can do it for a while if the credit card companies love them. But the second the lenders get nervous, the whole lifestyle wobbles. That's deficits in human form. Now take that household and add a magic printer that can pay the credit card in freshly printed coupons. The bills will get paid, but the coupons won't buy as much next year. That's the dollar dilemma. And 2025 made it worse because policy shifted. And the tightening campaign ended, and the system started leaning back toward support. Here's where people get confused. They hear support and think, good. Support is good for risk assets. Support can be good for jobs in the short run, but support is rarely good for the currency long term, because the currency is the receipt, and the more receipts you print, the less each receipt is worth. Now pause. This is where we need to be adults about it. This is educational. We manage risk. We don't need to predict exact dates or exact levels. We need to understand the direction of pressure and what it breaks first. So what's the pressure direction going into 2026? Lower yields, more liquidity, more deficit spending, and a world that is quietly trying to diversify away from depending on one currency. That last piece matters, because a dollar is only as strong as the global demand to use it. If other countries strengthen their own systems, by tightening policy, by attracting capital, by building reserves, then the dollar loses relative shine even if the US stays stable. In 2025, we saw a lot of that. We saw countries pushing to defend their currencies. We saw more appetite for hard reserves like gold. We saw investors looking at U.S. debt levels and asking uncomfortable questions. Not, will the U.S. default? That's the wrong question. The right question is, will the U.S. repay in dollars that buy the same basket of goods? And you already know the answer. Now, why should we care as normal people? Because a weaker dollar has a weird personality. It punishes you as a consumer and rewards you if you're positioned correctly as an investor. It's like the tide going out. If you're standing on the sand with your savings in cash, your feet get pulled. If you're in a boat with the right balance, you can ride it. Let's get practical. When the dollar weakens, imports get more expensive. That's your electronics, your components, your raw materials coming from abroad. Companies that depend on foreign inputs feel the squeeze. Margins get thinner unless they raise prices. Fact, input costs rise in dollar terms when the currency falls. Interpretation, businesses with weak pricing power get crushed first. Now flip it. Exporters can look stronger. If you sell a product overseas and foreign buyers have relatively stronger currency, your stuff looks cheaper to them. Demand can rise. Revenues can translate back into more dollars. That's why, in a weak dollar regime, certain parts of the market suddenly look like they grew a second engine. But don't get romantic. A weak currency doesn't automatically mean stocks up. If the weakness comes from recession fear, global demand can fall and exporters suffer anyway. So we don't chant slogans, we watch conditions. Here are the takeaways we need to carry into 2026, only the ones that actually move decisions. We need to watch rates, not the headlines, the path. If policy keeps easing, the dollar stays under pressure. We need to watch liquidity. When central bank balance sheets expand, risk appetite rises and the currency often weakens. When they shrink, the opposite. We need to watch deficits. Big deficits stay painless only if buyers keep showing up. We need to watch global competition. If other regions tighten while the US eases, capital chases yield, and the dollar can sag further. And we need to watch inflation psychology. Once people expect higher prices, behavior changes. That loop is hard to stop. Now here's a question that should bother you. If the dollar is weak, why do so many people still feel forced to hold it? Because it's the default setting. Your salary is paid in it. Your bills are priced in it. Your savings account is denominated in it. You're trapped in the unit you're trying to escape. So we don't escape by rage tweeting. We escape by allocating. An allocation starts with understanding what the market is paying for: growth, safety, or scarcity. In a weak dollar environment, scarcity assets start to whisper. Sometimes they scream. Gold is the obvious one, not because gold is magical, because gold is the inverse mirror. It reflects distrust in paper units. When the market fears currency dilution, gold often gets bid. When the fear fades, gold can cool for years. So we don't marry gold, we date it. We watch the fear gauge. Commodities can behave similarly. If it takes more dollars to buy the same barrel, the price in dollars rises, even if the real world supply hasn't changed much. But again, timing matters. Commodities can get crushed in a global slowdown even with a weak currency. The story is always two-sided. Now let's talk about the part nobody likes: cash. Cash feels safe. Cash feels like control. Cash is also a melting ice cube when purchasing power is sliding. So the real move is not all in on anything. The real move is balancing defense and offense. Defense, assets that hold purchasing power better than cash over time. Offense, assets that benefit when the dollar falls and liquidity rises. If we're wrong, where will it show first? It will show in yields. If yields spike while the Fed wants to ease, the market is calling the bluff. It will show in funding stress. It will show in debt auctions that don't clear cleanly. Now watch this next clue. A lot of people assume weaker dollar equals weaker America. That's not always true. Sometimes a weaker dollar is a policy feature. It can support exports. It can support corporate profits. It can relieve some debt burden in real terms. But it comes with a cost. The cost is domestic purchasing power. And the political risk of that cost is what makes 2026 spicy. Because when people feel poorer, they demand action. And action often means more stimulus, more protection, more intervention, which can weaken the currency further. That's the spiral we have to respect. So what do we do with this? We start by asking, what parts of the economy are positioned to benefit from a lower dollar without relying on fairy tale growth? Industrials can benefit when foreign buyers see U.S. machinery as on sale. Aerospace and defense can benefit when global demand stays firm and contracts are priced in dollars. Certain firms benefit when overseas revenue converts into more dollars. But the risk is obvious. If global growth stalls, those tailwinds weaken. So we watch global demand like a hawk. Here's another uncomfortable question. If the dollar keeps weakening, what happens to the assets priced in dollars? They can inflate in nominal terms. Houses can look like they're up a lot. Stocks can look like they're booming. But part of that can be the measuring stick shrinking. And that's why we always ask, are we getting richer or are we just seeing higher numbers? That's the difference between nominal returns and real returns. And real returns are what pay your future. So our job is to own things that can deliver real returns when the measuring stick gets shaky. That could mean diversified equities. That could mean selective real assets. That could mean a measured allocation to precious metals. That could mean exposure to businesses with pricing power. Pricing power is the king here, because when input costs rise, only companies that can pass costs through keep margins. Fact, margins get squeezed when costs rise faster than revenue. Interpretation. The winners are the ones who can raise prices without losing customers. Now let's talk about the Fed lever in plain English. When the Fed tightens, it pulls liquidity out, credit gets expensive, the dollar often strengthens because yields are attractive and dollars are scarce. And when the Fed eases, it pushes liquidity in, credit gets cheaper. The dollar often weakens because yields drop and dollars become less scarce. That's the basic lever, but the real world has friction. The Treasury is also issuing debt. The economy is also reacting. Foreign central banks are also moving. So we don't worship one lever, we watch the whole machine. And here's the machine risk in 2026. If the Fed wants to cut, but inflation refuses to die, they get cornered. Cut too much, inflation flares, currency weakens further, hold too tight, growth slows, markets wobble, political pressure rises. That's the box. And boxes create volatility. Volatility is where people make mistakes. They panic sell the bottom, they chase the top, they confuse motion with information. We're not doing that. We're going to use volatility like a sale rack. We buy quality when the crowd is emotional. Now I want you to do something right now. Drop a comment with this. What price hits you first when the dollar weakens? Groceries, rent, gas, or something else? And second question, if we're wrong about 2026 and the dollar rebounds, what signal would convince you early? Now hit subscribe. Short, simple. If you want clean signals through 2026, stay with us. Back to the markets. A weaker dollar can change leadership inside the market. Companies with more international revenue can look better on paper. Commodity producers can get a boost. Multinationals can benefit from translation effects. But beware the translation trap. A company can beat earnings because the dollar fell, not because demand rose. That is not the same thing as true growth, so we separate. Fact, foreign revenue converts into more dollars when the dollar falls. Interpretation, some earnings growth is currency, not customers. And if customers aren't growing, the party ends fast. So we watch volumes, we watch unit sales, we watch real demand. Now let's bring this back to your life. If you keep all your net worth in a checking account, you are trusting policymakers to protect your purchasing power. That's a bold bet, and it's a bet most people don't even realize they're making. Our goal is not to be paranoid. Our goal is to be prepared. Prepared means diversified. Prepared means liquid enough to breathe. Prepared means not over-leveraged. Prepared means owning assets that can fight inflation without taking reckless risk. Because, yes, there will be opportunities. There are always opportunities when the macro shifts. But opportunities are only opportunities if you survive the volatility. So we manage risk first. Here's a small detail that decides big outcomes. The spread between what you earn on dollars and what you lose to inflation. That's the real yield. If real yields stay attractive, global money can still choose dollars even if we complain about deficits. If real yields sink, holding dollars turns into paying rent for the privilege of losing purchasing power. Capital doesn't do that for long, and watch the geopolitical angle. In calm times, the dollar is the world's default language. In stress, it becomes the world's emergency exit. But if the stress comes from America's own inflation, that exit sign gets dimmer. Then you start seeing quiet behavior changes. More trade settled in local currencies, more reserves held in hard assets, more demand for alternatives, not because the dollar dies, but because the margin of safety shrinks. This is why the next few policy meetings matter so much. One sentence about being comfortable with higher inflation, and the market hears dilution. One hint that deficits will expand again, and the market hears more supply. One surprise spike in prices, and the market hears you're behind. So the key isn't guessing the exact bottom in the dollar. The key is spotting the first crack that turns a slow leak into a faster one. And here's the signal most people miss when the dollar drops, but foreign stocks and commodities rise together. That's not random. That's the market rotating away from cash. That rotation can run longer than you think. And we keep one eye on the bond market, because that's where the dollar story writes itself. The bond market is the thermostat. It tells you if the room is heating up or cooling down. If yields fall because inflation is under control and growth is stable, that's one story. If yields rise because buyers demand compensation for inflation and debt risk, that's another story. Those two moves can look similar in a clip, but they mean opposite things. That's why we don't do lazy analysis. Now, here's the cliffhanger that matters. Everyone is looking at the dollar chart. Almost nobody is looking at the why now of the next move. If 2026 turns into a year where easing continues and fiscal spending stays heavy, the dollar can keep sliding, while stocks still look strong in nominal terms. That is the most confusing environment for regular people, because you'll feel poorer at the store while your brokerage app looks up. And if you don't understand that contradiction, you'll make the wrong emotional decision at the wrong time. So we're going to keep calling it out. We're going to keep separating facts from interpretation. We're going to keep asking the only question that matters. What is our money actually buying? Because at the end of the day, wealth is not a number. its purchasing power. And the dollar just showed us in 2025 that it can lose that power faster than most people are prepared for. 2026 is where the consequences show up. Not all at once, not with fireworks, with a slow squeeze until something snaps. And when it snaps, the people who prepared look lucky. They weren't lucky. They were early. Stay sharp, stay flexible, and keep one eye on the bond market because the next big move usually starts there, quietly, before it shows up everywhere else.